In one of my previous videos, I covered 6 investing biases that you need to avoid. They were overconfidence bias, confirmation bias, loss aversion bias, herding bias, recency bias, and self-attribution bias. So in that video, I had covered 6 investing biases. However, I had mentioned that I wanted to cover more. So as promised, here we are. This is that video. Hopefully by the end of this video as well, you can acknowledge that you have some of these biases and start getting rid of them. Let's begin. Let's start with the first one, which is familiarity bias. It is the tendency for investors to prefer investing in companies or industries they are familiar with, even if there are better opportunities available elsewhere. So this is exactly what it sounds like. A lot of investors try to stick to things that they are familiar with. So this one's a bit tricky because you should be investing in things you understand. However, if your field of vision is too narrow, you're going to miss out on very good opportunities. To understand this bias, let's look at how it can impact your investing, starting with home country bias. A lot of investors are often overweight domestic stocks and don't have enough exposure to international stocks. If you're in the US, it might be okay because US is one of the biggest stock markets and most of the gains come from there. Even the best companies are there. However, if you look at a country like Canada, a lot of people are still sticking to domestic stocks over here. Even though what is recommended is that 60 to 70% of your investment should actually be in the US and only 30 to 40% should be in Canada. This might be same for your country as well. Maybe you should look elsewhere just to maximize your gains. The next one is sector overexposure. This is something actually I'm guilty of. I understand tech really well, so a lot of my investments are in the tech sector itself. Now, I keep a very close watch on the companies I'm invested in. However, I'm also investing in other sectors like financials. Generally speaking, investors over-allocate to sectors they know well, like tech or finance, leading to concentration risk. Basically, if you're only invested in one sector, you might get caught up in a sector downturn, leading to massive losses. The next one is ignoring promising opportunities. Basically, that's the general theme of this bias. You might miss out on opportunities that are actually very promising. For example, just think about the AI trend right now. There's one way to dismiss it, saying it's overhyped and I don't truly understand what's going on. However, if you really want to understand what's happening, you can put in the work. It's because these are the stocks that are seeing the most amount of gains right now, and if you don't truly understand what's going on, you might miss out on some obvious trades. However, I want to say that you should be very careful. Do your due diligence and don't try to jump into something because of just FOMO. Let's look at 2 tips to avoid familiarity bias, starting with recognize the benefits of diversification. Don't put all your eggs in one familiar basket. And secondly, research other companies and global markets to expand your circle of competence. The main takeaway here is that you should always keep learning and expand your horizon of investment. Especially as a retail investor, you must put in the work. You cannot rely on things like the news to tell you what to do next. The next bias we are looking at is the anchoring bias. It is the tendency to rely too heavily on the first piece of information when making decisions. The human brain has a general tendency to stick to pieces of information that it came across first. Let's look at how it really impacts your investing, starting with fixating on the purchase price. Investors generally tend to anchor to the price they paid for the stock. Now, this can cause 2 problems. The first is that you might want to buy more of the stock, however, the price keeps going up, but your mind is stuck on the initial price you paid for it, and you somehow want that price to come back, but it may not come back. So there's an opportunity cost of waiting. The second problem is that you may have bought a stock at a certain price. Now the stock price has been going down and you want to sell. However, you don't want to sell below the price you initially paid. But there's no guarantee that the price is going back to the price you paid for it. This might actually amplify your losses because you keep waiting for a certain price, but the price is moving in the complete opposite direction. The next problem is over-reliance on past prices. Investors often anchor to a stock's historical high or low prices when forecasting the future returns. This is a very common occurrence when you hear people say one day it's going to break to its all-time high again, but there's no guarantee of that, and this is where you keep anchoring to a price that is stuck in your mind. For example, look at the stock price of Cisco Systems. It peaked in the dot-com bubble and it hasn't even touched that price 24 years later. Imagine applying anchoring bias to this. You'd have been waiting for 24 years without actually succeeding. The next one is anchoring to indices. Investors for some reason anchor to the performance of the S&P 500, which is over 10%, and now they might be doing something totally different and still expecting the same performance from their portfolios. Firstly, if you're expecting that kind of returns, why not just invest in the S&P 500? Why do you want to play around with your portfolio and still expect the same outcome? You might be taking on more risk and trying to align yourself with the performance of something totally not in line with your goals. Do not try to anchor yourself to some arbitrary goal. Try to figure out what you really want to do. If you want to beat the S&P 500, a lot more work needs to be done, and it still might be very difficult to do that over the long run. So try to create a balanced approach to whatever you are trying to do. Here are 2 tips that might help you avoid anchoring bias. First is to gather data from diverse sources to avoid latching onto a single number. And the second is to revisit your anchors often and be willing to change them as conditions change. change. Basically, try to take a flexible approach to investing and don't try to anchor yourself to anything. The markets always keep changing, and so you have to also keep changing. The next bias we are going to talk about is called the disposition effect bias. It is the tendency where investors sell winning positions too early while holding on to losing positions for too long. In simple terms, you're holding on too tight when you're losing and you're letting go too early when you're winning. That's not the right way to invest. Sometimes you need to cut your losses fast and not take profits for a long period of time. Let's see how this bias impacts your investing. First, as mentioned, it's selling winners prematurely. Basically, this is due to risk aversion. You see some profits in your portfolio. You want to realize them as soon as possible, and this may not be the right decision. Sometimes you gotta let your winners ride. The next one is something that's also in the name, that is holding on to losers for too long. Again, loss aversion plays a role here in the opposite direction, where you don't want to take a loss and you keep holding on to a stock thinking it's going to break even at some point, but it may not happen. You have to remind yourself that in investing, you have to take losses once in a while. Even Warren Buffett takes losses. The main thing is to cut your losses as soon as possible. As soon as you realize something's not working out, try to get away from it. The next one is you are ignoring tax implications. Investors often fail to harvest losses for tax purposes or consider the tax implications of realizing large gains. Again, profit and loss is not just the only thing you should consider. You should also consider your tax implications. Maybe if you sell, you can realize some of those losses and offset some of your gains. And maybe you don't want to take profits right now because it might cost you a lot due to taxes. Here are 2 tips that might help you. First is to set rules around selling and stick to them. Remove emotion from the equation. And second is to be disciplined about cutting losses. Define your risk tolerance in advance. If you're an investor, you should have a set of rules for yourself. It should be both in the positive and negative direction. You should know when to sell, even if it means taking a loss. You should also always doubt your investment thesis. If something's not working out, take the loss and move on to the next one. The next bias we are looking at is called the endowment bias. This is the tendency for people to value an asset more highly simply because they own it. This is something you must be very familiar with. It basically means my asset is the best asset. Let's look at how it impacts your investing. Firstly, you are overvaluing your portfolio holdings. You may view the stocks you own as being worth more than the identical stocks that you don't own. This is something you might be doing subconsciously. Let's say you hold company A. Now there's a company B which is exactly like company A, including the numbers, but you'll downplay company B just because you don't hold it. You need to be careful. Don't let emotions get in the way of valuations. The second is you are overestimating the value of local assets. Investors may overvalue real estate businesses or stocks from their own home region. This kind of goes in conjunction with the familiarity bias which we have discussed in this video. Because of having a closer connection to your home region and the assets within that region, you might want to value them more than they actually are. Again, you have to be objective when it comes to these things, and here are 2 tips that can help you avoid endowment bias. The first is to ask yourself if you would buy the investment today if you didn't already own it. If not, consider selling. And second is to seek objective input on valuation from people who aren't emotionally invested. The only way to avoid this bias is to really keep your emotions out of the investing world. Investing is about numbers and not about emotions. By the way, if you're enjoying the video so far, hit like and consider subscribing. And if you haven't checked out part 1 of this video, feel free to check it out. We cover 6 investing biases in that one as well. The next one is called the hindsight bias. It is the tendency for people to overestimate their ability to have predicted an outcome that could not possibly have been predicted. If I had to explain this in simple terms, it would be the phenomenon of I knew it. I knew this was going to happen. A lot of investors tend to say these things after something has already happened. To better understand this, let's look at how it plays an important role in your investing, starting with overestimating predictive abilities. As I just mentioned, in hindsight, investors may believe they knew all along that a stock would go up or down. The reason people feel this way is because once something has happened, a lot more facts have come to light, and now you start to believe that, oh, I think I knew this was going to happen. But your thinking has already been swayed by the information you just came across. The next is it can lead to chasing past performance. Hindsight bias can fuel performance chasing as recent returns seem predictable after the fact. Basically, it's very similar to something we looked at in the previous video that was called recency bias, where it can lead to performance chasing. You see that the stock has just done something, like say it's gone up 50%. You start to believe that it can do it again, which may not be possible. The next one is misperceiving risk. With the benefit of hindsight, risky investments can seem safer than they actually were. So a quick way to understand this is that let's say a stock you were expecting to go down ended up going up for some reason. Nothing about this stock has fundamentally changed. The numbers haven't changed and nothing has changed. But do you think the risk has changed just because the price went up? The answer is no. If you believe there was certain risk to this stock before the price went up, the risk hasn't changed if fundamentally nothing has changed. Remember, price is what you pay, value is what you get. Just because the price went up doesn't mean the value of the stock has changed. Here are 2 tips that you can use to avoid hindsight bias. The first is to document your investment thesis before making a purchase. Hold yourself accountable for your original reasoning. This is something that I just spoke about. The only way to understand your reasoning is to have it written down somewhere. If something unexpected happens in the market, all you need to do is go back to your investing journal and see what you were thinking then and for what reasons. The next is to seek feedback from others on the quality of your decision making process, not just the outcome. So I understand this may not be achievable for a lot of people, but I'll tell you what I do. I have a small circle of friends where I discuss all things investing, not just the outcome, but every single thesis that I'm formulating. Basically, before I get into a stock, I try to float the idea among these friends and try to get their reaction and see what they're going to say. This way, I'm able to get feedback on my investment thesis and not just share my gains or losses with them. Now we move on to the last investing bias, that is the illusion of control bias. This is the tendency for people to overestimate their ability to control or influence outcomes that they in fact have no control over. So this is something I fell prey to in 2020 and 2021. There were certain trend changes in the markets and I started to believe that just because I was changing with the trends and I see a few people changing with the trends, it was happening across the world, which was not true. Let's see how this can impact your investing. Starting with excessive trading. Investors who think they can control the market may trade excessively, leading to higher costs and lower returns. Basically, with the illusion of control, you try to do more than you should. You just start trading, going in and out of the market and end up losing more money than you should. The second is you're trying to time the market. The illusion of control may cause investors to believe that they can successfully time their entry and exit points. You must have heard of the saying, time in the market beats timing the market, and there's a lot of truth to it. This does not mean you should not be trading. You can always indulge in swing trading of some sorts. But what's important is to keep the long term in mind. And the last one is you're neglecting diversification. Investors may overconcentrate their portfolios in a few investments where they feel they have special knowledge or influence. This is something you'll actually see with crypto people quite a lot. They try to influence a lot of things because of how small the market is. But if you come in as a retail investor and try to take part in it, you may not even have that influence and you might get wrecked. Here are 2 tips that you can use to avoid illusion of control bias. The first is to embrace a long-term diversified strategy rather than trying to time the market. And second, recognize that many factors affecting investment decisions are beyond your control. Focus on what you can control, like asset allocation and costs. To be honest, the only thing you can truly control is the buy and sell button. When it comes to markets, there are lots of macro factors, there are lots of market factors that you have no control over. So those were the 6 additional investing biases I wanted to talk to you about. As I mentioned in the previous video, the key takeaway is that we all have these biases hardwired into our brains, but we can mitigate their impact by being aware of them using tools like decision journals and checklists, seeking out diverse perspectives and sticking to a long-term plan. Hopefully the 12 investing biases we spoke about in this video and the previous video add some value to your investing journey. That's all for today. I'll see you next week in a new video. Till then, keep learning and stay on top of your finances. Until next time.